Namaskar. This is the second monetary policy statement of the current financial year, and this is how it goes. In the recent years, the world has gone through one crisis after another, and the pattern continues. Even against this backdrop, the Indian economy exhibits strong fundamentals together with financial stability and positive growth momentum. Nevertheless, we need to remain vigilant in an unsettled global environment. The new realities brought about by technological advancements, supply chain realignments, trade and financial fragmentation, and climate change pose opportunities as well as challenges. In this milieu, India looks ready to embark upon a new era of transformation aided by a favorable demography, improving productivity and technology, and a conducive policy environment. The confluence of these factors brightens the prospects of sustained high growth in India in the years ahead. As the Reserve Bank approaches its centenary year, that is RBI at 100, it will gear up even more to remain future ready for India's fast-growing economy. It will take steps to enhance India's global footprint. For our journey during the next decade, we have drawn up strategies consisting of policy actions towards positioning the Reserve Bank as a model central bank of the global South. The agenda for the run-up to RBI at 100 is documented in the annex to this statement. I urge all keen observers of the Indian economy and the financial system to take a close look at these action plans. This is not a static document. It cannot be a static document, as we are living in a dynamic world. Our endeavor will be to continually update it as may be required from time to time. I would now turn to the decisions and deliberations of the Monetary Policy Committee. The Monetary Policy Committee met on 5th, 6th and 7th June. After detailed assessment of the evolving macroeconomic and financial developments and the outlook, the MPC decided by a 4:2 majority to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is SDF, rate remains at 6.25%, and the marginal standing facility, that is MSF rate, and the bank rate at 6.75%. The MPC also decided by a majority of 4 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns to the target while supporting growth. I shall now briefly set out the rationale for these decisions. The inflation growth balance is moving favorably. Growth is holding firm. Inflation continues to moderate, mainly driven by the core component, which reached its lowest level in the current series in April 2024. The deflation in fuel prices is ongoing. Food inflation, however, remains elevated. While the MPC took note of the disinflation achieved so far without hurting growth, it remains vigilant to any upside risks to inflation, particularly from food inflation, which could possibly derail the path of disinflation. Hence, monetary policy must continue to remain disinflationary and be resolute in its commitment to aligning inflation to the target of 4% on a durable basis. Sustained price stability would set strong foundations for a period of high growth. Accordingly, the MPC decided to keep the policy repo rate unchanged at 6.5% in this meeting of the MPC. The MPC also decided to remain focused on withdrawal of accommodation to ensure anchoring of inflation expectations and fuller policy transmission. I would now like to provide an assessment of the growth and inflation conditions. Let me first briefly touch upon global growth. Global growth is sustaining its momentum in 2024 and is likely to remain resilient, supported by rebound in global trade. Inflation is easing, but the final leg of this disinflation journey may be tough. Central banks remain steadfast and data-dependent in their fight against inflation. Market expectations regarding timing and pace of interest rate cuts are also changing with incoming data and central bank communication. US dollar and sovereign bond yields remain range-bound. While gold prices have surged on safe haven demand, equity markets have gained in both advanced and emerging market economies since the last MPC meeting in April. Let me focus now on the domestic growth conditions. The provisional estimates released by the National Statistical Office, NSO, placed India's real gross domestic product, that is GDP growth, at 8.2% for the year 23-24. During 24-25, that is during the current year so far, domestic economic activity has maintained resilience. Manufacturing activity continues to gain ground on the back of strengthening domestic demand. The 8 core industries posted healthy growth in April 2024. Purchasing Managers Index, that is PMI in manufacturing, continued to exhibit strength in May 2024, and it is indeed the highest globally. Services sector maintained buoyancy as evident from available high-frequency indicators. PMI services stood strong at 60.2 in May 2024, indicating continued and robust expansion in activity. Private consumption, the mainstay of aggregate demand, is recovering. And it is recovering with steady discretionary spending in urban areas. Revival in rural demand is getting a fillip from improving farm sector activity. Investment activity continues to gain traction on the back of ongoing expansion in non-food bank credit. Merchandise exports expanded in April with improved global demand. Non-oil, non-gold imports entered positive territory. Services exports and imports rebounded and posted a strong growth in April this year. Looking ahead, the forecast of above normal southwest monsoon by the Indian Meteorological Department, that is IMD, is expected to boost Kharif production and replenish the reservoir levels. Strengthening agricultural sector activity is expected to boost rural consumption.